Hello friends, welcome back to part 17 of my Tesla 2022 Q3 earnings forecast review video series. Let's jump right back to where we left off in part 16, which was with non-GAAP earnings and non-GAAP earnings per share diluted. So this video is going to be about PEG ratio, price to earnings to growth, which is a really important concept for people to understand if they want to invest in companies that are growing their earnings rapidly. And the only thing I want to say, looking at my spreadsheet right now, is that Tesla's earnings per share are going to grow. I have them growing by a lot in my forecast. So these are the two most recent quarters of actuals. These were the actuals from prior quarters. Now, if none of these numbers look familiar, that's because I had to adjust these for the 3-for-1 stock split that just happened a month ago, less than a month ago. And you can see here that on that basis, in 2021, Tesla's earnings were about $2.26. And this year, so far, Tesla's earnings are $1.83. That's pretty good, given that this quarter was a problem quarter for Tesla. Like, most of the profitability metrics were down sequentially for Tesla due to those Shanghai lockdowns in Q2. So this is an awfully good start against this base from a record year for Tesla in 2021. But what I'm forecasting for Q3 and Q4 is a lot more growth. A little over $5 per share. Now, Wall Street will back out 45 cents of what I'm forecasting in this quarter if Tesla takes the benefit from prior year's losses in Q4, as I expect they will. And this 530 would drop by 45 cents to $4.85. But that's still pretty good to have $5 worth of earnings a year after having only $2.25 worth of earnings per share, right? Well, what's going to happen the following year? I'm forecasting in 2023 $11.72. So more than doubling from here to here, more than doubling from here to here. And the year after that, I mean, that's a long way out into the future, folks. Don't hold me to it. But what I have in my model for 2024 is $23.43. Again, more than double the earnings. Year after year after year, Tesla keeps growing earnings because they keep expanding their business and selling more products more profitably, right? So that's all I wanted to say about this. Before I keep moving down the page and talk about a lot of fun stuff that I have working in my model in regard to PEG ratio, the P, E, and G here aren't labeling the row they're on. They're just telling you this is the PEG section of my model. What I'm going to do is bring up Investopedia to their page that explains what is price to earnings to growth ratio. And I'm not going to read this whole page to you. Let me zoom in here some more so you can see it a little better. Yeah, that's probably... Well, can I make this really, really big? Yeah, I can make it really, really big. Okay. So hopefully those of you watching this on your phones can now read what's on the Investopedia page. I'll leave a link in the video description to this. So what they say is the price to earnings to growth ratio, PEG ratio, is the stock's price to earnings ratio divided by the growth rate of its earnings for a specified time period. And before I go very much farther into this, I'll just say people do PEG ratio in lots of different ways. Everybody has their own recipe for how to make a PEG ratio. So there is no one universally agreed upon way of calculating PEG ratio, but the idea is that looking at PE by itself is too simplistic to work, right? You can very easily compare the PEs of lots of different companies. Just, hey, what's the stock trading for right now? I'm going to divide that by their earnings per share, and that'll give me a number. Okay. And then I'll compare all the companies, and whichever one has the lowest PE is the cheapest, so that's the one I should buy. Well, that is too simplistic an analysis. You will buy some bad companies if you follow that investing approach, because there are probably good reasons why the price is so low for those companies. They may be in a lot of trouble. They may have eroding earnings. They may be at bankruptcy default risk, right? And those are the reasons why the stock market is not placing a lot of value on those companies' earnings, right? Okay, I'll keep reading. The PEG ratio is used to determine a stock's value while also factoring in the company's expected earnings growth. This is important. You're investing in stocks because you want your money to grow over time. One of the surest ways of making sure that's happening is to invest in companies that are going to be increasing the amount of money they earn by a lot as time goes by into the future over your investing time horizon. And it is thought to provide a more complete picture than the more standard PE ratio. So it's very easy to learn low PE ratio equals good. It's short and it's simple and it's easy to remember, and those are the pros that are in favor of PE ratio. But if you suspect that that's not all there is to the story, you're right. Okay, so key takeaways: the PEG ratio enhances the PE ratio by adding expected earnings growth into the calculation. So yeah, you're just modifying that PE or putting it into the context of, all right, yeah, this company has a really high PE. This company has a 90 PE. This other company has a 9 PE. So is this company 10 times more expensive? Well, if you're looking backward at the earnings that these companies have been generating only, then yeah, maybe one of them looks 10 times cheaper than the other one. But if you look at the growth that's expected of these companies going forward, maybe one of these companies isn't going to grow earnings at all, and the other one is going to grow them by 150% per year, right? So if you're interested in investing in that company for a long period of time, it's going to grow into the multiple. It's going to grow, the earnings are going to grow that company into lower PE over time, right? All right, the PEG for a given company may differ significantly from one reported source to another because people calculate it different ways. Differences depend on which growth estimate is used in the calculation, such as 1 year, 3 year, or 5 year projected growth. PEG lower than 1 is best, suggesting a company is relatively undervalued. So in general, a lower PE is better. In general, a lower PEG is better, right? Because you're just taking that PE and you're dividing it by a growth rate. How fast are the earnings growing? And they have a fun little video here. I'm not going to play that. But here's what the formula looks like. So price divided by EPS up here is just the PE ratio in the numerator. And then in the denominator, it's how fast are earnings growing. So here's how you can look those up. Anything else I wanted to say about these? The degree to which a PEG ratio result indicates an over- or underpriced stock varies by industry and by company type. As a broad rule of thumb, some investors feel that a PEG ratio below 1 is desirable. According to well-known investor Peter Lynch, a company's PE and expected growth should be equal, which denotes a fairly valued company and supports a PEG ratio of 1. When a company exceeds 1, it's considered overvalued, while a stock with a PEG of less than 1 is considered undervalued. All right, so I would have phrased this sentence slightly differently. I would have said, according to well-known investor Peter Lynch, a company's price is a good value if its PEG ratio is less than 1, right? He would have said it's a bargain for me to buy a company with a PEG below 1, and I'm not going to pay more than a peg of 1 for a stock because that's too rich. All right, I've probably said enough about the Investopedia article. Go check out the link if you're interested to read more. But let's just dive through these calculations and see, all right, what did I have to do in my model to come up with these numbers? And I'll just run down the Q3 2022 column, which is my first forecasted month, explaining to you what these rows do. So for next 12 months non-GAAP EPS, I'm just looking at, well, how much will the earnings per share be over the 4 quarters that follow this quarter? So in the case of these, you can see it's just summing up these cells right here and saying, all right, well, in Q4, Q1, Q2, and Q3, it's going to be a total of $10.29, which is what that cell is doing, and that's all it's doing. Okay, the next thing is the year-over-year non-GAAP EPS increase. So the next thing you might ask is, well, is this good? Is this bad? How do I know? I should compare it against something, right? And the thing I'm comparing it against is the prior year same number. So way over here for 404, what's this doing? It's doing exactly the same thing we just saw this cell doing. It's looking at the 4 quarters that followed and adding them up and saying, hey, over this 4-quarter period, including at this point 3 quarters of actuals and 1 quarter of my forecast, it's $4 worth of earnings over that time period. And a year later, the forecast for the next 12 months of earnings is $10.29, an increase of $6.25. So that's all this 625 says. And then what does this earnings growth rate do? It compares this 1029 to this 404. And it says, all right, if I divide this number by this number, and then I subtract 1 to take off the base, that's 155% growth. Or the other way you could do it is to, look at these two numbers and take the 1029 divided by the 625. You get the same number. 155% growth is what we're expecting over the next year. And you can see it's been that way for a while, over 100%, and will go back to being about that much in the future. All right. According to my forecast, which will be wrong. I feel like I should always say. All right, so what's next? Well, I've got 3 different ways of calculating PE ratio. Yes, you can calculate PEG ratio a bunch of different ways. You can calculate PE ratio a few different ways. So the first one I'm going to look at here is the trailing 12-month non-GAAP earnings, which I think is a pretty standard one. Okay, here's that $4.04 from the prior year that we just looked at. And here's a stock price forecast that I have for Q3, which is $371. Now, maybe Tesla will not get there during Q3. It sure looks like they're not going to so far this quarter. But my forecast for where the stock price ought to be in this quarter is $371. We're well below that for now. So at that price, if Tesla were trading at $371, it would have a PE ratio of 92. All right, but not everybody does their PE ratio that way. Some people do it based on the GAAP number instead of the non-GAAP number. Okay, so here are the 12 trailing months of GAAP earnings up here as the bottom part of that fraction, the denominator. And then it's the same numerator, that price target of $371 in V1204. Now I've got another one here. This PE ratio is based on the next 12 months of GAAP earnings. So if I want to look forward instead of backward at what's coming over the following 4 quarters and divide my price into those earnings, how much am I paying per dollar of earnings? Only $38 looking forward. So if you do backward PEs, you get numbers that look like this. And if you do forward PEs, you get numbers that look like this. Tesla is a much bigger PE bargain if you look at the earnings that we expect will happen over the next year instead of the earnings that have happened over the past year. Hope that makes sense. And then we have the PEG ratio here. So you should be able to tell me by now what this PEG ratio is. It's this $92 PE ratio, which I think is a good one to use. Trailing 12 months non-GAAP, $92. I'm going to divide that by this 155. Now the convention here is that to make the math work in a spreadsheet, you have to multiply the 155%, which is just the number 1.55, by 100 to get it onto equal footing with this 92. So you can do math on it. But it's very handy for mental math to just talk about, hey, here's the PE, here's the growth rate percentage. It works better with stuff like, hey, it's a 20% growth rate, it's a 20 PE, okay, that's 1, that's fair value, right? And you get a 0.59, indicating that Tesla is trading at a bargain right now, as you would expect. We're right in the middle of a big bear market over the first 9 months of 2022, and prices are depressed relative to where they were previously. So this ratio has been higher in the past, and I'm projecting that it will go higher in the future. Now that's a long time from now, folks, Q4 of 2024, and at that point, what will my projected stock price forecast be? A lot higher than it is right now. So that's, 4 times, a 4x on your investment over a 2.5-year period, if my forecast is right. And it's guaranteed not to be by me, the person who made it. So that gets us to a Peter Lynch PEG equals 1 price target. So what's this say? This says if you believe that the most you should pay for a stock is a PEG of 1, then what is the most Peter Lynch would pay for this stock at this time to get fair value for money invested? And it would be $625, which is more than double where the stock is trading at right now, if you believe what I'm forecasting for the earnings. Now, James, how can this be so disconnected from reality? It's because, as Gary Black points out all the time, Wall Street's earnings estimates for Tesla are too low. They're not forecasting Tesla to earn the kind of money I'm forecasting that Tesla will earn, or the kind of money that he's forecasting that Tesla will earn, even. And I think Tesla's going to beat Gary's earnings forecast. And there's a lot of other great retail Tesla investors out there who are forecasting something more similar to what I am than what the Wall Street consensus estimates are per the Bloomberg terminal that a lot of these multi-billion-dollar fund managers are using as their reference for, hey, what is Tesla's earnings potential? They're based on Wall Street analyst estimates that are too low, in my opinion, for what Tesla's earnings are going to be. And the next line here says 12-month price target, historic PEG ratio adjusted. So this line is saying take this V1236, this $10, multiply it by 100, and multiply that by the average of the PEG ratios over the past 4 quarters, and that'll give you another way of doing a price target on Tesla. As you've seen, I have a few different swags at ways that you could forecast future Tesla stock prices. And there's another one here, which is Stevenson Indicator, which I've made a whole playlist of videos about that you can go check out if you would like to know what this is doing. And with that, this GAAP net income is just a repeat of what we've already seen up top that I'm going to be using to get to adjusted EBITDA, and that'll be my next video. So with that, I'm going to close this video and say, if you've enjoyed today's video about PEG ratios, click the like button. It's free to click the like button on YouTube. There's no charge to do that. And you can subscribe to my channel if you're not subscribed and want to see more videos like this in the future and the other videos that I make. You can subscribe to my channel. Ring the bell if you want to get notifications or alerts when I post fresh content. And I will see you in part 18.